I'm going to teach you the easiest way for a veteran to lower their mortgage payments. That's right, a streamlined refinance program called an Earl, which is an interest rate reduction refinance loan, is one of the best loans out there. Okay, so if you're one of those individuals that's purchased in the last 3 to 5 years and you feel that burden of having to take a higher interest rate, 2026 might actually be the year that you can lighten your load just a little bit. So if you're a veteran, service member, surviving spouse who already has a VA loan and has purchased a home, you could be eligible potentially for what's called an Earl. And you definitely want to take advantage of it. So today, I want to walk you through some of the fundamental things you need to understand about a VA Earl. So one of the things that I want to walk you through is there are, and I want to guide you through this, is there are just some fundamental rules that you should understand about a VA loan, okay, and the Earl program. Who am I? My name is Kevin Retcher. I'm the owner of First Meridian Mortgage. You're watching The Till, and I am a Marine veteran, 30-year mortgage broker, and I've been ranked as one of the top veteran loan officers in the country for over the last 20 years. I've been ranked by volume in the top 10 multiple times. I'm also an independent insurance agent. I own KSA Insurance Agency, and I'm also a licensed realtor with Jobin Realty. So everything to do with your home, I am licensed to either help you find it, sell it, finance it, or insure it. So I am more than qualified to walk you through this VA Earl. Okay, so first and foremost, there are a lot of good characters out there, and there are a lot of bad characters out there. The bad typically are not going to explain the cost. They're going to try to roll in a lot of points. They're going to try to convince you can skip 2 payments, that you can roll all of this into your loan, and not actually walk you through fundamental numbers. The good are people that are going to walk you through those numbers so that you can have an educated conversation and decision with you and your wife and decide what's best for you. So simply put, there's kind of 4 steps in looking at whether or not you should do a VA Earl, maybe 5. So first and foremost, you have to have an existing VA loan. You also have to meet timeline requirements. You had to have had the loan for at least 210 days from the date of your first payment, and you will have had to have made at least 6 consecutive payments. You have to lower your interest rate at least 0.5% in rate, and you also have to recoup your closing costs within 36 months. One of the other things that people don't know is that if you have an ARM on a VA loan and you can do an Earl to a 30-year fixed, and you don't have to meet the 0.5% requirement, but you still have to meet the timeline. Another thing that people don't always understand is that, let's say you have PCS to another state, and this house was at one point your primary residence, you can still do an Earl even if it's now a rental. No other loan allows you to do that. So VA loan is absolutely the best loan out there. So a couple things. So those are the things that you have to keep in mind. And so let's go through. I'm going to show you a transaction so that you can kind of understand what I'm talking about when it comes to closing costs. So this is actually a client. I kind of changed the names a little bit. In this particular case, I'm going to take you to the second page of your loan estimate. And what I want you to see here is cost generally are box D, box E added together, minus box J. your credits, okay? So in this particular situation, this person was able to get 5.625 as an interest rate and got a credit of $12,155 toward their closing cost, right? Their actual cost were $24.93 and $8,249 added together, so call that roughly about $10,600. So this person actually ended up getting a no-cost refi, and this extra money that would be left over on lender credit would actually go toward boxes F and G, which are their escrows. So when you do a refinance, you do have to establish your loan to the end of the month, so they paid 5 days of interest. So this person would skip a payment and then get escrows back from their current lender. So in this case, D plus E minus J, they came out ahead. And that's what you're ideally looking for. Now, if this number in box J covered all of D minus E, but didn't cover this funding fee, I would generally be okay if you rolled that into your loan. It does allow you, the VA Streamlined Earl, technically, if you had zero credit, would still allow you to roll this entire amount in regardless of your equity position. So that is one of the key things I want you to understand. Other loan officers, the bad loan officers, know that it does not matter whether you have money in the bank. They don't care whether or not they just rolled in $17,000 in cost. They don't care. As long as it meets that 36-month recoup time, they don't care whether or not you went backwards or not. So that's the bad in this program. It allows for those particular equity stripping type of scenarios. And you say, well, Kevin, potentially I could skip 2 payments, roll that all in, and go on vacation or do something of that nature. If that's really what you want to do, as long as you understand what you're doing, then go ahead and do it. But the best VA IRRRLs are ones that cover the closing cost, and the client brings F and G, your escrows, to the closing table. So in this scenario, this client still brought $5,400 to the closing table, which was essentially F and G minus the extra credit that this person got. Now, how did we get here? Remember, the person had to have had at least a 0.5% lower interest rate. These were the numbers on this particular client. She purchase price $999,999 back in October of 23. Her first payment was December 1st of 2023. So I called her up and said, hey, I can refinance you and get you a 0.5% lower interest rate and do an Earl and pay all your closing costs. And so we went through that process, and I sent her the documentation. But before I did that, I gave her these numbers, right? So let's look at some of these numbers. She's on payment 332. A lot of people say, well, I don't want to go backwards. I've made 28 payments. And in general, if it's a no-cost refi, what I want to educate you is you generally never go backwards unless you want to go backwards, okay? It's about knowledge. So this spreadsheet has her saving $481 per month for free because it was a no-cost, right? And so my spreadsheet tells you right here, if you paid $191 of that, you would pay the loan off essentially the very same time frame. If I add an extra $192 of the savings, $331 versus $332. Why should someone do this refinance? Think about if you paid the same amount of money you would pay the loan off in 297 months. So you would be saving 35 payments by saving 0.5% on this Earl. How much money does that equate to in this scenario? As much as $300 and some $1,000, $318,000 over the life of the loan. Even more if you go ahead and make those larger payments. So in the end, when people say, oh, I don't want to go backwards, the difference between going backwards and not going backwards, don't go backwards. Pay the $481 and save the money. You actually save more money by doing that. Time value of money, you're paying things off quicker, paying less interest. So a no-cost refi, again, is when you add up D and E minus credits in J. Okay? And first and foremost, my name is Kevin Retcher. I am the owner of First Meridian Mortgage. And just to quickly recap your Earl scenario, right? 0.5% lower interest rate or greater. Have to have had the loan for 210 days from the first payment. You have to recoup all your closing costs within 36 months. You can go from an ARM to a fixed rate. You can roll all the cost into the loan if you want. You can skip 2 payments, but I generally run from anyone that uses that as a sales pitch. It's a negative, okay? If you do a second, and I just want to break it down for you. If you rolled all those things in and skipped 2 payments, and then rates dropped and you did that again, think about rolling in tens of thousands of dollars twice, okay? And where your balance is and where it could be. So a word to the wise, beware of anyone that starts with, you can skip 2 payments. And in general, D plus E minus J. My name's Kevin Retcher. I'm the owner of First Meridian Mortgage. 36 years ago, I bought my first house and used my VA. And 2 years later, I did a VA IRRRL. And a lot of points and costs were rolled into my loan, and I really didn't understand what I was doing. Within a year after that, I became a loan officer. And 3 years later, after that, I'd opened up my own mortgage broker shop, First Meridian Mortgage. My phone number's not changed in 30 years. Being a Marine, I am full transparency on everything I do, and I enjoy educating and teaching you, and I have one goal in general, and that is to save you money. And if I save you money, I'll make some along the way. So to all the Marines out there, I'm going to say simplified. To all the other servicemen, thank you for your service. If you have any questions, if you have a conventional loan, a no-cost refinance works similar on a conventional loan also. If you have any questions, feel free to reach out. This is The Till, which is truth in lending and in life, and I'll talk to you soon.